Hi, hello, welcome to all. In this video, we are going to discuss about non-resident test your knowledge questions. From test your knowledge questions, first question: P is who returned to India on 12th June 2021. That is 12th June 2021 means financial year 21-22 will be the financial year. That is previous year. Next, permanently after stay about 20 years. So previously from this is previous year. In this previous year he is not a non-resident. He is not a resident, not a resident first of all. Next, provide that source of is various. Firstly, we will see that he is resident or not resident. From here 21 to 31st March 2022 it will become more than 182 days. So more than 182 days means he is resident. And next conditions was resident or ordinary resident. We will see based on two conditions will be satisfied. That is, first condition will be for previous year we will see how many days he have, and for out of at least 2 years must be stay in India for last 10 years, and 730 days 731 days out of 7 years. So he is from about 20 years he is not in India, so he is not a ordinary resident. So he is resident but not ordinary resident. First one. Next, second, here what I provided, what we they require and seek your opinion to know about his liability to income tax there are in India in assessment year 22-23, assuming that he does not want to opt for provision of section 115 BAC. Next, income of rent. So he is, firstly we write here resident but not ordinary resident, okay. From his he have some income. So what is that income? Income of rent of flat in India which has deposited in bank. So he has rental income from London and he is deposited in bank account. The flat was given on rent by him after his return to India since July 2021. So he is deposited, and he after he returns he was their rental income. So it is accruing outside India and receiving outside India. He is a resident but not ordinary resident. So it is not taxable in the hands of India. He is not taxable here. Next, dividend on shares of 3 German companies which are being collected in bank account in London, and he proposed to keep the dividend on shares in London with the permission of Reserve Bank of India. So he is a investment in outside India and he is receiving in India. He is receiving amount in outside India and he is a resident but not ordinary resident. So it is not taxable in India. Next case, he has got 2 sons, one of whom is 12 years and other 19 years, but both his sons are staying in London and not returning in India with him. Each son has having income in 75,000 in UK and 20,000 in India. So when is India 20,000 means where the income he have minor income, it must be included in parent income as per clubbing provisions. So who is the person minor 12 years person? His income was 20,000, and when providing this income 20,000 we will give the exemption under section 10, that is 1500 will be provided. So 20,000 minus 1500 we will add back to 18,500 will be added to his income. Next, during the preceding accounting year when he was non-resident, he had sold 1000 shares which were acquired by him in British pound sterling, and as sale proceeds were repatriated. The profit in terms of British pound sterling on sale of these 1000 shares was 175% of cost and 37,500, while in terms of Indian rupee it was 50,000. So here the repatriation of sale proceeds where the income was accrued outside India and he has purchased outside India and he got some amounts and that amount was repatriated to India. It is not taxable in hands. So only this amount will be added, and we will see the answer now. P is returned in India on 12th June 2021. That is previous year 21-22 it will become after staying 20 years. So he stayed in India for 293 days. So 293 days, since he has stayed in India for a period of 182 days or more during the previous year 21-22, and he would be resident in India for the assessment year 22-23. However, he would be resident but not ordinarily resident, assuming that he was non-resident in 9 out of 10 years. So when he be not treated as ordinary resident, when 9 years, that is 2 years, we write 2 years out of 10 years, and 731 days out of 7 years, they are right in other way, that is out of 9 out of 10 years and 730 less than 730 days out of 7 years, they write in. Next, resident, ordinary resident, we are then, and only the income which is received deemed to received or accrued or arise deemed to accrue or arise in India is taxable in case of resident and but not ordinary resident. So where the income accrues or arise outside India shall not be included in total income unless it is derived from business controlled in or profession set up in India. Now here we provide that rental income from flat in London which was deposited in bank, there shall not be taxable in case of resident but not ordinarily resident, since both the accruals and the receipt of income outside India, it is not taxable. Next, other case will be dividend from share of 3 Germany companies collected in bank account in London, which would also not taxable in case of resident but not ordinarily resident, since both accrue and receive income outside India, so it is also not taxable. Next, as per section 64(1)(a), all income accruing or arising to a minor child including in the hands of parents after providing for deduction under section deduction 1500 per child under section 1032 according the income of 20,000 accruing to his minor son aged 12 years in India, he is included in the terms in income of Piyush after providing deduction of 1500. Therefore 18,500 is included in Piyush income. Income accruing to minor child outside India and not included in income of Piyush, since other son is major, so who is a major will not be included, and income not included in the income of Piyush. Next, repatriation of sale proceeds 1000 shares sold in the preceding accounting year when Piyush was non-resident is not taxable in assessment year 22-23, since it is not the income of previous year 21-22. Next, consequently, only the income included under section 64(1)(a) would form part of total income of Mr. Piyush assessment year 22-23, since its total income only 18,500 is less than the basic exemption meant, there will be no liability to pay tax. Next, second case will be Mr. Dravid, a citizen of India serving in the Ministry of External Affairs in India, that is government employee is a person, and he was transferred to Indian Embassy in Canada. So government employee went to Canada. So whatever the allowance he is received, he will get exemption under section 10. Next, he did not visit India any time during the previous year. He has received the following income for the financial year 21-22. Salary computed. So salary will be taxable in the hands of employee who is a government employee, and even though he went outside, it will be accrue year, so it will be taxable in India. Next, foreign allowance, it will be exempted under section 10. Next, interest on fixed deposit from Bank of India, so it will be taxable, it will be exempted. Income from agriculture in Pakistan, income from house property in Pakistan, so it will not taxable in India because it is not accrue or arise in India. Next, what computing gross total income of assessment year 22-23 will be as per section 6(1). Mr. Dravid is a non-resident for assessment year 22-23 since he was not presented in India at any time during the previous year, and according to section as per section 652, non-resident is chargeable to tax India only in respect of following incomes. So he is a not presented in India, so he is treated as non-resident for assessment year 22-23. Next, income accruing or income received or deemed to be received and income accruing or arising deemed to accrue arise in India, it will be taxable in India. It will be taxable only when he is a non-resident. It must be received and deemed to receive accrue and deemed to accrue, it will be taxable in India. Next, in the view of above provisions, income from agriculture Pakistan, income from house property of Pakistan would not be chargeable to tax in the hands of David, assuming that same was received in Pakistan. Next, income from salaries payable government to citizen of India for services rendered outside India is deemed to accrue or arise in India, and hence such income is taxable in the hands of Mr. Dravid even though he is non-resident. However, allowance or perquisites paid allowance allowed as a such outside India by the company by the government to a citizen of India or for rendering service outside India is exempted under section 10(7). Hence, foreign allowance of 4 lakhs is exempted under section 10(7). Next, gross total income of Mr. David for assessment year 22-23. Salaries will be 5 lakhs and income from other sources will be 1 lakh. Gross total income will be 6 lakhs. Next, question number 3. Mr. A citizen of India who is left USA for the purpose of employment. So, he is a person went outside India for the purpose of employment. He has not visited India thereafter. So, Mr. A borrow money from his friend Mr. B who has left India for employment purpose 1 week before Mr. A departure. Okay, a person is there and he went to USA and he has not visited India, and A borrowed some money from B, and after A is coming, B is going outside India 1 week before A departures to the extent of 10 lakhs was loan amount. 10 lakh was loan amount and buys the shares in X Limited, an Indian company. Discuss the tax liability. In interest is chargeable at the rate of 10%. So there is 10% interest will be chargeable for in the hands of B if the said interest is received in New York. So if B is received outside India, it will be taxable. So here whatever therefore if interest is payable by Mr. A on money borrowed from Mr. B, if he is investing in shares Indian company, shall not be deemed to accrue or arise in India in the hands of Mr. B. So because he is not invested, Mr. B, if Mr. B is taken and invested in New York, then it will be taxable in the hands of Mr. B. But here he is not the person and he is not investing here, so he is not the case. For here where the A is there, A is the person, so we will see the residential status of both the persons and income will be C. See, an individual is said to be resident when individual is said to be resident in India in any previous year when if he has been in India during the previous year for a total period of 182 days or more. When he is a 182 days or more, then he will be treated as resident in India, and or has been in India during for 4 years. That is, here they provided 4 years immediately preceding the year total period of 365 days. 365 days and at least 60 days in that year. So we must to satisfy either 182 days or more, or we can satisfy the next one, that is out of 4 years, out of 4 years he must stay in 365 days and at least 60 days in that previous year. If he satisfied both the conditions, if he satisfied any one condition, he will be treated as a resident. After that, in case of an Indian citizen leaving India for the purpose of employment outside India during the previous year, the period of stay during the previous year in condition to above to qualify as resident would be 182 days instead of 60 days. Next, if he is a person citizen of India, then it will be treated as would be 182 days instead of 60 days here at least 182 days for that year. Next, in that case, Mr. Hay in Indian citizen who left India for employment outside India, so he is a person resident outside India. Then we will see the 182 days conditions. 182 days conditions when he went outside India, and we will see if he is went outside India for on employment on 1/5/2021 and 1/5/2021. So 1/4/2021 to 1/5/2021 it was 21 days. Since in stay in India during previous year 21-22 is only 31 days, does not satisfy the minimum criteria of 182 days. stay in India for being resident. Hence, his residential status for assessment year 22-23 is non-resident. Mr. B, who left India 1 week before a departure, is also a non-resident for the same reason. So he is coming and he is going, then also he is not stay, B is also not stay more than 182 days, so he is also treated as non-resident. Now here both are non-resident. Then section 9(1) provides that income by way of interest payable by a non-resident in respect of any debt incurred or money borrowed and used for the purpose of business or profession carried out by such person in India shall be deemed to accrue or arise in India. Therefore, interest payable by a non-resident in respect of any debt incurred or money borrowed and used for the purpose of making or earning any income from any source other than business or profession carried on by him shall not be deemed to accrue or arise in India. Therefore, interest payable by Mr. A on money borrowed from Mr. B to invest in shares of an Indian company shall not be deemed to accrue or arise in India, and hence he is not taxable in India in the hands of Mr. B. Next, JJ Limited, a company incorporated in Australia, has entered into an agreement with KK Limited. So JJ Limited is there and KK Limited is there. Both are in agreement. For what purpose? Rendering technical services to later for setting up a fertilizer plant in Orissa. As per agreement, JJ Limited render both offshore and onshore services. So is rendering both the services of to KK Limited at a fee of 1 crore and 1.5 crore respectively. JJ Limited is of the view that it is not liable to tax in India in respect of fee 1 crore as it is rendering outside India. Discuss the correctness of view of JJ Limited. So he is paying for 1 crore and 1.5 crores. So totally he is paying 2.5 crores. That is for both offshore and non-shore. And he is deemed to accrue or arise in India. So both will be taxable in India only. And his view is wrong. Outside India, his view is wrong. Next, here we will see clarify that income by way of fee for technical service for services utilized in India would be deemed to accrue or arise in India under section 917 in case of non-resident and be included in his total income whether or not such service were rendered in India. In this case, technical services rendered by foreign company JJ Limited were for setting up fertilizer plant in Orissa. Therefore, services were utilized in India. Whatever the services were utilized in India, consequently, as per the fee, whatever the fee is charged, 2.5 here, 2.5 crores for technical services rendered by JJ Limited, both offshore and onshore services to KK Limited in deemed to accrue or arise in India and included in total income of JJ Limited. Therefore, we of JJ Limited that it is not liable to tax in India in respect of 1 crore as it is rendering outside India is not correct. Next, fifth question. In fifth question, examine with reason whether the following transaction attract income tax in India in the hands of recipient under section 9(5) of Income Tax Act 1961. That is, they are provided some transactions and we must say that incomes in the hands of recipient transaction attracting income tax. Okay, a non-resident person is there. Okay, non-resident Germany company which did not have permanent establishment in India enter into an agreement for execution of electric work in India. So he is executing work in India. Okay, separate payment were made towards drawing design which are described in as engineering fee. Engineering fee means that is a technical professional fee. Okay, technical fee. Next, whatever the amount they are paying, technical amount is paying. So it is paying for non which is company, outside company, and which does not have permanent establishment in India. So the whatever the business profit should be taxable in Germany and there is no business connection with India. So it is not taxable here and it will be taxable in Germany. Next, business profit should be taxable in Germany as there is no business connections in India. They are telling like that. And we see what is the year income is included, total income of the non-resident, and where the government, where the Germany company, regardless of whether resident POB is there or not, it will be taxable because that is nature of technical services. Technical services is taxable in India by virtue of section 9(1). Next, a firm of soliciting in Mumbai engaged a barrister in UK for arguing a case before Supreme Court of India. Next, a payment of 5,000 pounds was made as per terms of professional engagement. Payment of 5,000 pounds was paying. Okay, here the amount paid for barrister in UK, you are paid in UK, and that is professional engagement. So when the professional engagement, it will be chargeable in India. Chargeable to India is because it was form of soliciting in Mumbai. Next, amount paid by Government of India for use of patent developed by Mr. A. Government of India is using the patent developed by Mr. A, who is a non-resident. That is third question, where here A is non-resident and he is receiving income from Government of India. So it will be taxable in India in the hands of Mr. A. Next, Sai Engineering, a non-resident foreign company, entered into a collaborative agreement on 25/6/2021 with an Indian company and was in receipt of interest at 8% debentures for 20 lakhs issued by Indian company in consideration of providing technical know-how utilized in its business in Mumbai during the previous year 21-22. Okay, and here they providing which services are providing, the interest is payable. So here interest was 8% is interest is payable. So it will be taxable in India for 20 lakhs. So we will see the answer. So all are taxable na. Okay. Fee for technical services is taxable under section 9. In this case, the separate payment made towards drawings and designs. So he is paying drawings and designs a separate payment in engineering fee or in the nature of fee for technical service and therefore taxable in India by virtue of section 9(1). Since the services are utilized for execution of electrical work in India. Next, as per explanation below section 9(2), where income is deemed to accrue or arise in India under section 9(1)(7), such income shall be included in total income of non-resident Germany company, regardless of whether it has a resident or place of business or business connection in India. Next, as per section 9(1)(1), all incomes accruing or arising where directly or indirectly through or from any business connection. So is there any business connection? If there is any business connection in India, is deemed to accrue or arise in India. Next, in this case, there are professional connection between the firm of soliciting in Mumbai and barrister in UK. So there is business includes not only trade and manufacture. So business includes not only trade and manufacture. It includes within the scope of profession as well, and therefore existence of professional connection amount to existence of business connection under section 9(1). It's so held by Supreme Court. So the amount 5,000 pounds paid to barrister in UK as per terms of professional engagement constitute income which is deemed to accrue or arise in India. It will be taxable in India. Next, as per section 9(1), income by way of royalty. Any royalty paid by Government of India deemed to accrue or arise in India. Here royalty means what? Royalty means consideration for use of patent. So when the amount was paid for the use of patent, it will be treated as royalty. Therefore the amount paid by Government of India for use of patent developed by Mr. A non-resident, is deemed to accrue or arise in India. Hence it is taxable in India in the hands of Mr. A. Next, 20 lakhs being the value of debentures issued by Indian company in consideration of providing technical know-how for use of its business in India. So why the debenture was issued? Because there is providing technical know-how for the consideration of technical know-how for use in its business in India. Next, in the nature of fee for technical service deemed to accrue or arise in India to CI Engineering, who is a non-resident person, foreign company, and hence it is taxable in India. It is taxable in India. Next, 911 income by way of interest payable, royalty where technical know-how consideration will be taxable, and the amount which is interest is payable, it is also taxable in India. Next, since the question specify require the candidate to examine the taxability of above transaction under section 9, so the provisions of double taxation avoidance agreement, if any applicable in the above cases, have not taken into consideration. Next, question number 6. What is there in question number 6? Question number 6. Jed, an American tourist, comes to India for the first time. First time means he is not there in India for last year. Next, when he was came June 17, he was came from June to 2017 to, and how many days he has stay in India. He lives in India on September 29th. So up to September 29 he stay in India. For June it was 30 days is there, no? June means 30 days. So 30 minus 16, it will become 14 days plus 30. July means 31, August means 31, September 29. So total 105 days is stayed in India. And would your answer, if he is a person of Indian resident and his total income from Indian source, it will be 16 lakhs. So if he is a person non-resident and he does not satisfy either of basic conditions, then he will treated as non-resident. And non-resident, when a person, if he is a person of Indian origin and whose total income exceeds 15 lakhs, he would still be a non-resident for assessment year 22-23 for becoming a resident but not ordinary resident. So he should stay in India for at least 120 days. So when you want, for instead of 182 days, we will take 120 days. Sorry. It will be seen only the additional conditions. Firstly, we have 4 conditions. For 4 conditions, what is that 4 conditions? One is 182 days, conditions 1, and another one is 4 years, 365 days and 60 days at least. This is either one. And next we have for out of 10 years 2 years must be in India, and out of 7 years 5 3 I think 721 or 731 days. I forgot it here. How many days? 731 days, I think so. 731 days. Yes, 7 years means 731 days. This is both conditions is there, and this is basic conditions will be satisfied. Where here 60 days is there. No, for 60 days we will take 120 days. He had stayed in India for at least 120 days in previous year, and 365 days is 4 immediately preceding years. In 365, in 460, this condition will be satisfied, since his stay in India for previous year 21-22 is less than 120 days. He would be non-resident in India. So first person we will see 182 days or 365 days and 60 days. When he is a person point of he is a citizen of India and his total income is from outside India exceeds 15 lakhs, from Indian source exceeding 15 lakhs, then we will see instead of 60 days we will see 120 days. Next, question number 7. What is there in question number 7? Mr. Global Airlines Incorporated has a company in USA operated its flights to India and vice versa during the financial year 21-22, April 21 to March 22, and collected charges will be 125 lakhs for the carriage, passengers and cargo out of 65 lakhs was received in New York in USA. Okay. Next, 125 collected charges and cargo out 65 lakhs was received in New York, US dollars for passenger fare book. So 125 minus 65, whatever the amount was received here. For 125 was collected charges, and out of 125, 65 will be the cargo out. So this 65 will be removed. That is fare book value we will get, and with the fare value, this 65 will be from New York to Mumbai. Next, from here we will get one amount, that is we will see the deemed income we will can pay at the rate of 5%. That is for whatever the amount we will get. 125 minus 65 means 60 into, there is a percentage, 5% percentage, I think so, it will be taxable. Next, on operations of such flight was 950 lakhs. Next, compute the income chargeable to tax foreign airlines. So as per section 44 BBA, in case of non-resident engaged in business operations of aircraft, 5% for the following amount would be deemed to be profits and gains for such business. Paid or payable whether in or out of India to the assessee or to any person on account of carriage passenger, livestock, mail, goods from any place in India, and this is paid, this is received or deemed to received in India by on behalf of assessee on account of carriage or passenger, livestock, mail, goods for any place outside India, from any place inside India. Here, fare book from India to outside India, fare book from New York to Mumbai, India or not. Here fare will be 125 minus 65, that is 60 lakhs, and 65 lakhs directly given, and from 60 lakhs fare will be there. It will be taxable at the rate of 5%. Since the amount not received in India, so it will not be taxable. Next, 8th question. What is there in 8th question? In 8th question, they provided that Atlant, a company incorporated in France, was engaged in manufacture, trade, supply, equipment, service for GSM circular radio telephone system. It supplies hardware, software to various entities in India. Software licensed by assessee embedded the process which is required to control and manage the specific set of activities involved in the business use of its customers, and also made available to its customers who used it to carry out their business activity. The assessing officer contended that the consideration for supply of services embedded hardware in royalty under section 9(1). Here, assessing officer, assuming that the software that was loaded hardware and embedded the system does not have any independent examination. So issue was involved that whether it will be case of which is correct or not. Assessing officer correct or not. Assessing officer is not correct. Why we issue under consideration in this case whether consideration for supply of software embedded in hardware would tantamount to royalty is attracting deemed accrual. So for royalty it will be deemed accrual where software embedded with hardware, for this consideration it is both is not a royalty. Only the service will be treated as royalty income. So we will see the royalty condition. Royalty paid by person who is a resident in India would be deemed to accrue or arise in India. However, where it is payable for the transfer of any right or the use of any property or information or utilization of service for the purpose of business or profession carried on by such person outside India for the purpose of making earnings, any income from any source of outside India, the amount payable by way of royalty would not be deemed to accrue arise in hands of non-resident. Here what they have provided, only the who is the resident India, and however transfer of any right or use of property or information or utilization of services for the purpose of business or profession carried on by such person outside India for the purpose of making earning any income from any source outside India, amount payable by way of royalty would not be deemed to accrue or arise in India in the hands of on resident. Here royalty includes only the transfers of all or any rights for use or right to use computer or software irrespective of medium through which such right is transferred. Only the computer software will be treated. Next, the fact of similar case was provided. The court observed that software supply is an integral part of GSM mobile telephone system and is used by cellular operator for providing cellular services to its customers, where payment is made for hardware in which the software is embedded and the software does not have independent functional existence. No amount could be attributed as royalty for software in terms of section 9(1). Next, in this case, since the software that was loaded on the hardware and embedded in the system does not have any independent existence, there could not be any independent use of such software. Therefore, rationale of Delhi High Court ruling can be applied in the case of ANTH. Accordingly, action of assessing officer is treating as the consideration of supply of services embedded in hardware as royalty under section 9(1) is not correct. That is question number 8.